Welcome back. We have breaking news. New Canadian gross domestic product numbers have just hit the screen. They are stronger than expected. The fourth quarter gross domestic product number for Canada comes in at an annualized pace of 1.0%. That is 20 basis points more than the 0.8% expected by economists. We also get an upward revision to the prior number. This would be third quarter GDP, now comes in at a contraction of 0.5%, not the contraction of 1.1% that was initially reported from Statistics Canada. We have a leading Canadian economist standing by, David Watt of HSBC. We'll talk to him in just a moment. In the meantime, here are some stories that we're tracking for you here in the BNN Bloomberg newsroom. Toronto Dominion Bank has exceeded estimates on both the top and bottom line, driven by strength in both its capital markets unit and its domestic retail business. On the downside, however, provisions for credit losses rose to about $1 billion. And like other Canadian banks this quarter, TD took a charge from a U.S. regulator related to potential bank failures and the need to top up a deposit insurance fund. CIBC also topped estimates, though adjusted profit declined compared to the same period the year before. Revenue climbed by 10% in the bank's Canadian business. Provisions for credit losses rose to $585 million. CIBC says the increase reflects the current economic environment, particularly in the U.S. office and in Canadian consumer portfolios. Revenue and profit fell in the latest quarter at a small Canadian bank, Laurentian Bank of Canada, partially due to costs related to a computer system outage that hit the bank last year. The Quebec-based lender says it has a strong level of liquidity, as it has also strengthened its capital position and looks forward to launching its revamped strategic plan later this year. There's another look at the U.S. futures, a different picture there south of the border. I'm just going to take a quick look at my screen to see if we've had U.S. economic data released in the past couple of minutes. We have personal income, personal spending numbers, and the PCE deflator numbers have all come in. Those PCE deflator numbers are considered crucial to the Fed. What I can tell you is that those numbers are exactly in line with expectations, those PCE deflator numbers. I won't go through the details, but there's no variance between what the economist community was expecting on PCE deflator numbers and what has been reported. Where there is variance is on personal income. Personal income came in much stronger than expected. We'll get to those numbers in a moment. Let's talk to David Watt in the meantime on these numbers from Statistics Canada on the Canadian gross domestic product. David, you've had a period of time to look at the numbers. What do you think?
A short little period. They're basically all over the map. The headline numbers, like we got a better Q4 GDP number, and not a surprise that the contraction in Q3 was revised downward because the trade numbers looked like that was going to suggest that. So Canadian economy wasn't as weak in Q3, doing well coming into year end. But the December number was flat, which was quite a surprise to suggest, so did we lose momentum going into year end on a monthly basis? Mm-hmm. But the January number looks like it's going to rise 0.4. So again, it's this idea that the Canadian economy just continues to show some resilience in the face of the higher interest rates and the struggles that
longer term, what's the narrative here? The slowing Canadian economy? Do we know where it's going in terms of this trajectory?
Well, growth has slowed, and I think that's sort of confirmed again. And it's the idea, like, is it slowing enough to prompt an early Bank of Canada rate cut? No. Is it going strong enough to suggest that maybe the bank has to hike rates? No. So it is sitting on the sidelines, waiting to see how things evolve until conditions are in place for the bank to start cutting interest rates, which again looks like around mid-year.
I'll do one controversial, just because there's not that much in this numbers, and the one thing we were looking for is the consumer, and also the government stimulating. It doesn't, government's a big part of the Canadian economy, but it's not that big. Do you have any work on the idea that if you take out 1 million, new Canadians, and you X that out, that actually last year, if we're still looking at last year's figures, was an awful lot weaker than, but it was stimulated also just because you had a million new Canadians. Have you seen anything on it, or do you have any comment on that?
Well, we have a lot of sort of focus on GDP, and I suppose looking at GDP here, we look at GDP per capita. And so that sort of shows our consumption per capita, and they all show that when you take into consideration population growth, a lot of these economic trends are softening. So you also have the idea that the consumption numbers were so strong in Q4. Maybe that's because of the contribution of the new immigrants as well. So we are getting some positive contributions from that, but we're also get the idea that when you look at some of the underlying stats, growth is not keeping up with population growth. And on the important point about that one is the numbers that came out today is we're not getting an investment boom. And so what we're seeing is investment continues to contract. So from the Bank of Canada's perspective and say the performance or the generation of income, what we're getting is that productivity story is still a huge challenge for the Canadian economy. So if we had high population growth and high productivity, it would be fantastic for the Canadian economy. But we're missing that productivity story, which creates a number of hurdles for the economy and for generating income for all those new immigrants.
We also have received a so-called flash estimate. That's a preliminary, very much subject to revision estimate for January. So a forward-looking number from StatsCan today suggesting gross domestic product expanded by 0.4% in the month of January. That would be the strongest monthly pace in a year. Bloomberg attributes this to a resurgence of activity after public sector strikes in Quebec came to an end. Your thoughts, Bill, on January perhaps being the strongest month of growth? I'm sorry, David.
That's all right.
In the strongest month of growth in a year.
That strike activity, we did expect that. We knew hours worked had increased in January because of the end of the strikes in Quebec. But again, even then, taking that away, it's like most of the preliminary numbers suggested that January would be softer than that. So still looks like the economy started the year fairly well. Not necessarily a sign that it's all clear in terms of economic growth, but again, it started the year better than we anticipated going into Q1. Coming out of Q4, the Q1 GDP number looks like it might be a little bit better than maybe we thought, which was going to be about flat. So again, it's that idea that the economy is not doing great, but it's also not really doing poorly. And so from the Bank of Canada's perspective, they're not seeing signs yet that suggest, yes, it's time to start discussing rate cuts. It's still, we have to just wait and see.
What is the read-through from these numbers to inflation? Are these inflation positive numbers?
Again, you've got everything on a couple of different ways to look at it. One way that I would sort of say is the Bank of Canada is very focused about wages and productivity. And with business investment this soft, it does not suggest that productivity is coming back yet. So companies are going to be facing labor costs and weak productivity backdrops. And are they going to start to try and pass through price increases? So again, it's the idea that the way things are evolving, yes, we seem to be heading towards rate cuts and easing inflationary pressures. But at the same time, the Bank of Canada can't sort of declare victory yet because companies still might find with labor costs going up, they have to sort of pass through some price increase.
You've mentioned productivity, weak productivity, a couple times. Your brethren and your brothers and sisters in the economics community mention this a lot. What are some of the policy solutions that you'd like to see, perhaps longer term, to Canada's lagging productivity?
Oh, where do we start? We know that we've got this transition towards a low-carbon economy. We've got to have everything that we can to sort of make that transition, whether it's the electricity system, being able to handle all the charging of the electric vehicles, and we basically got to make the investment to electrify, basically, our transportation system. I mean, that's a big one. That's a huge investment story that's out there right now on a big macro scale. And then for individual companies, we need tax policy that continues to contribute and suggest to companies, as opposed to leaving your earnings in the United States, maybe bring them back and invest them in Canada and tilting the balance in Canada's favor.
David.